Welcome, everyone, and thank you for joining us today. We are delighted to have you with us. My name is Lindsay Marenkov, and I'm a Senior Trust Officer with Johnson Trust Company and a member of our Thrive Network. Whether you're joining from your office, your home, or somewhere in between, we appreciate you taking the time to be part of this conversation. While we may not be together in person, we hope this webinar provides a meaningful opportunity to connect, learn, and reflect. Before we begin, I'd like to thank our presenters, Laura, Andrea, and Mary, for sharing their time and expertise with us today. We're fortunate to be joined by these three incredibly thoughtful professionals who each bring a wealth of knowledge and a genuine passion for helping others. Their insights and generosity are what make events like this possible, and we are so grateful for their participation. Here at Johnson Investment Counsel, we are committed to harnessing the power of female professionals, not only within our firm, but throughout the communities we serve. We believe we are stronger together, learning from one another, building networks of support, and encouraging one another to thrive, both personally and professionally. Our Thrive Network, which is hosting today's webinar, reflects that commitment by providing women with valuable tools, educational opportunities, and meaningful relationships that foster confidence and growth. Throughout my time at Johnson, I've seen firsthand our dedication, not only to helping clients manage their wealth, but to partnering with them as they pursue what matters most. Programs like this webinar are an extension of that commitment, and we are both honored and excited to share this time with you today. With that, I will turn it over to Laura, Andrea, and Mary to share their insights. We hope you enjoy this webinar, and thank you.
Thanks, Lindsay. My name is Mary Burns. I am Senior Vice President and Senior Trust Counsel at Johnson Trust Company. I'm also Vice President and Gift Counsel at Johnson Charitable Gift Fund. I'm a shareholder at Johnson Investment Counsel, and I've been practicing law for about 25 years.
Thanks. And I'm Andrea Ernst. I'm a Senior Portfolio Manager here at Johnson Investment Counsel. I've been in the industry now for 17 years. I'm also a shareholder at the firm. I'm a certified financial planner, and I help our clients with their investment management and financial planning needs.
My name is Laura Mattern. I have been at this firm for 8 years. Like Andrea, I'm a senior portfolio manager and shareholder of the firm. I'm a chartered financial analyst and certified financial planner, and I work with individuals and families providing investment management and financial planning. So I'm going to kick things off for us. You are tuning into a financial planning webinar, and you might think that we're going to start by talking about numbers and budgets and investments, and those are all important parts of planning, but effective planning begins somewhere more personal with your vision. What do you want your money to make possible? What do you want your life to look like? Before we can talk about spreadsheets or rates of return, we have to ask some deep questions and do some reflecting. When I work with clients, a common goal I hear is, I want to retire at 55. It's kind of that magical early retirement age. And that can be a great goal. But I've also seen people work for decades towards that one milestone, only to feel surprisingly lost when they get there. Without clarity on what retirement means beyond not working, the achievement can feel less like a triumph and more like an identity crisis. Often our goals are more about feelings, emotions, things we want more or less of in our life. We may say we want to retire early, but what we really want is more time to travel, pursue hobbies, spend time with the people we love. We may say we want more money, but what we really want is to feel free, secure, in control. So last year I told you not to let your emotions drive your investment decisions, and this year I'm telling you to go ahead and let your emotions determine your vision and goals. I know, it's confusing. But there's a difference between letting your emotions determine your short-term investment strategy and allowing your values to shape your long-term vision. Financial planning isn't accumulating money for its own sake. It's using your resources to support living the life you want to live. So I encourage clients to ask themselves a series of questions to get to their deeper vision. Questions like, why do I want this? What would success look like? What's my core motivation? What do I want more of in my life? Or what do I want less of in my life? And there can be more than one strategy to achieve the same goal. Maybe the real goal isn't to retire at 55. It's less stress, more flexibility, more control over your time. That can be achieved by retiring early, but it also can be achieved by switching roles, reducing hours, taking a sabbatical, or designing work differently. I have a client who is a local CEO and she loves her job. Her friends are beginning to retire. She's beyond the normal retirement age, but she tells me she doesn't want to retire ever, and I believe her. But when her first grandchild was born a couple of years ago, she wanted to be really involved in his life, and she decided to carve out one day of her week to spend with him while his parents were at work, and that became her version of success. So once we know where we want to go, we need to build a strategy to help us get there. Every successful financial plan is built on 3 pillars: protect, build, and enjoy. Protection is about building a strong foundation. It starts by having an emergency fund. Most people know that it's recommended that you have 3 to 6 months of living expenses in cash or money market for those unexpected life events. Insurance is part of protection as well. For many of us, our largest asset isn't something we own. It's not our home or our retirement account. It's our human capital, our ability to earn income over time. So it's important not to overlook having the proper amount of disability insurance or term life insurance. Estate planning is part of protection, and that's Mary's area of expertise, and she'll talk about it in more depth later on. But protection isn't just protecting what you own, it's protecting the people and priorities that matter most. So this means ensuring that your beneficiaries, the documents that you have, and the decision makers align with your wishes. The second pillar is build, and this is where we focus on saving and investing. We say this every year. Saving is important, but saving alone is not a strategy. Investing is what allows your money to grow and work for you over time. Building wealth is about being intentional. Where do your dollars go? How are they invested? How much risk are you taking? And whether your decisions align with your bigger picture. This doesn't mean that you have to do everything perfectly. It's building good habits and staying consistent. So the third pillar is enjoy, and this is the fun one. It takes us back to our vision practice at the beginning. Because financial planning isn't just about financial stability, it's using your resources to live the life you want to live. So this might mean travel, generosity, giving to the people and causes that are important to you, or simply creating memories while you're healthy enough to enjoy them. Sometimes people are very good at saving and investing, but struggle to give themselves permission to enjoy what they have. Other people are really great at enjoying today, but need structure around protecting and building for the future. The strongest plans will balance all 3. You want to protect yourself from the unexpected, build for the future, and enjoy your life along the way. Because financial planning isn't a one-time event, it's an ongoing process. As your life changes, your plan should evolve with you. Your family may change, your goals may change, your career may change. The market is always changing, so it's important to stay flexible. A successful plan shouldn't make you feel restricted or overwhelmed. It should increase your confidence and expand your choices. So as you reflect on your financial life, I encourage you to come back to these 2 ideas. 1, define your vision. Know what you want your money to make possible. And 2, build a strategy. How will you protect, build, and enjoy your resources in a way that supports that vision? Now I'm going to turn it over to Andrea to talk about investments.
Yeah, thank you, Laura. That was really great. And I'm going to go ahead and just dive a little deeper into one of the topics that you mentioned, because while it is great to have our feelings and emotions help build our vision, we absolutely do not want to bring our emotions into our investing, which is really hard to do. And as women, you may have heard that we're more conservative investors, or that we tend to be more conservative. So we may not have the level of stock exposure that we should have in our portfolio, or maybe we're holding on to too much cash. And I get that. There is a comfort that comes with being a little bit conservative. However, when it comes to your goals, being conservative is going to hinder you from reaching them. So I'm here to help us build up some resilience to that market risk. And so what I'm going to do is I'm going to show us two charts. And I know financial charts, how very exciting, but stay with me because these are what I call my sleep at night charts, so I think they're going to help. The first chart that I'm going to show you is the history of the S&P 500 going back to 1926, so about 100 years there. And the S&P 500 is just simply an index made up of 500 of the largest U.S. companies. So think of like NVIDIA, Microsoft, Procter & Gamble, Chevron, right? Companies that you know. And when we look at this chart, the way that we read it is the orange boxes represent the years that the market are up, or it's positive for the year, and then the gray boxes represent the years that the market was down. And so just visually, we can see that the majority of the time the market has been up. There's a lot of those orange boxes. And in fact, if we go back over those nearly 100 years, the market has been up about 75% of the time. And so I do not gamble, I do not place bets. However, those are great, great odds. The other thing that I like when we look at this chart is that visually you can see that when the market is up, it tends to be up. So there's a lot of times that the market is up over 10%, 20%, or even 30%. And then when the market is down, it tends to be down 10% or less. So again, those are really great odds. And when I show my clients this chart, they tend to put their glasses on, they squint their eyes, and they look at all the different numbers because they just don't quite believe it. And I get it. It doesn't feel this way. This chart just shows where the market ended for the year. It doesn't show us the journey that we took to get there. So the next chart is going to show us that journey. And in particularly, that yellow diamond represents the journey. That represents how far back in a given year the market pulled back. And then that blue bar represents where the market ended up. So let's take, for example, 2020. We all can remember that year. At one point, the market was down 34%. However, the market does a fantastic job of working through uncertainty, and it actually ended up 16%. So the reason why I'm showing you this chart is because, again, visually, you can see there's a lot of yellow diamonds, meaning market volatility is completely normal. It's just part of the investment process. So when you hear things like the market is down 800 points or 1,200 points, again, just know that's completely normal and part of your investment journey. So please keep your long-term assets invested and don't let short-term market risk impact, again, that long-term growth. So let's say you are listening to our conversation and you get excited about that. So you go ahead and you increase your stock exposure, or maybe you add some cash. Again, these are for your long-term assets. And then all of a sudden we experience market volatility and you're panicking and you want to sell out. Please give me a call. I will talk you through it because market timing never works. There's actually a saying in our industry where it's about time in the market instead of timing the market. And I want to share some numbers with you. If you would have invested in that same S&P 500 going back 25 years or more, so in the year 2000, and you just let it ride, you didn't touch it, you'd have about $65,000 right now. However, if you missed just 10 of the best days, and again, there's like over 9,000 days in that time period. So 10 of the best days, you'd essentially cut your returns in half. So about 33,000. And if you miss just 20 of the best days, you've essentially like lost, you haven't lost money, but your returns are basically diminished on that. And so again, stay in the market for your long-term investors. Okay, so here's where we're at now. We have created or thought about your vision, created a strategy, become a little bit more resilient to the market. There's one more piece that's going to be important to your plan, and that's how you implement it. And in my opinion, delegation and automation are going to be the two best tools that you have. Because I don't know about you, but I'm very busy. The mental load is very real and it's very heavy. And even what we're talking about here today can feel like another line item on your to-do list. And so automation and delegation are going to turn your good intentions into consistent action. And you're not just going to rely on how much time and energy you have in a given week. Because I know, again, that's small for a lot of us, very little. So the easiest place to start are with systems that run without your consistent attention. So think of like your 401k, for example. Most people are already contributing into a 401k or 403b. and that's great. But don't stop there. See if the plan can also set up automatic rebalancing. If so, set it to rebalance every 6 months or a year, and that's going to allow your allocation to stay within your target range. The other thing that you can look for with your 401k plan, if you're not already maxing out your contributions, is see if you can increase it 1 or 2% every year. So as you're getting your annual raise, you're also paying yourself that raise into your 401k. Some other areas you can think about from automation are automatically setting up investments into a brokerage account or a 529 plan. Please, if you are doing that, make sure you're actually investing. So many people automatically set the cash to go in and it sits. So you can look to see if you can automatically get that invested into, say, a mutual fund or ETF for stocks and bond exposure. The other thing you can look at is if you have debt with a high interest rate, see if you can set up automatic payments or even extra payments to start to reduce that. And then delegation. When it comes to delegation, I believe that everybody, well, most people should have a team of 3 professionals, and that's a CPA, an estate attorney, and a wealth advisor. That might also be called a financial advisor, or in our terms, portfolio manager. Those terms can be interchanged. But think of that team as your family's personal finance department. And just like any successful business relies on their departments working together, your financial life is going to be best when your advisor, CPA, and attorney are all aligned and connecting and communicating with one another. So if you haven't done so already and you have this team in place, please go ahead and send an email connecting everyone and giving permission for us to share information on your behalf. For confidentiality reasons, until you actually connect us and allow us and give us permission to share again information, we can't work together on your behalf in implementing your plan. When your advisor can coordinate with your CPA and estate attorney, we can work on things like tax withholding strategies, capital gains planning, Roth conversions, beneficiary designations, just to name a few. So the goal is ultimately just to reduce the amount of communication that has to flow through you. You don't always have to play the middlewoman. Let your advisor and your team coordinate the communication department. Communication. You are always in charge. You will ultimately have the end say, but again, the goal is to reduce the amount of work that is on you. And then finally, kind of tying in to what Laura said, I also want to give you permission. So if you are sitting here today and you're thinking, I'm in good shape, I have my vision, my strategy, I'm reaching my goals, I'm not panic selling every time the market adjusts, and you're doing well, delegation isn't just about for your finances, it's also for you just to get your time back. So please, hire someone to clean your house, get someone to do the yard work. Maybe it is finally hiring that CPA so you're not spending a weekend every year filing your own taxes. I'm fully giving you permission to enjoy the money that you earned, because like any good leader, they know where they add value, they want to spend time with the people they love the most, and they build trusted teams to do the rest. And so from here, I'm going to go ahead and kick it off to Mary, and she's going to talk more about estate planning.
Okay, thank you both. I think that this is all such good advice, and I think that when people hear about estate planning, the 401k sounds like something a lot of jobs have, and estate planning can sound like something that only high net worth individuals need, and I would argue that every single person, first of all, has an estate plan, whether you know it or not, and needs an estate plan. So the one you have, whether you know it or not, is going to be set for you by the state statutes in which you live. So I would not like to leave my things to the government in terms of what should happen to my property and how at the end. So I think that it's wise to have an estate plan. That's when you call the attorney that you have on your team and say, we need to start talking about this. I think that what Laura said about using emotions and how you're creating your vision and your goals are really important for your estate plan, because it's about your property, but really it's also about the beneficiaries of your estate. So it's going to be about your family, and if there are causes that you have that are important to you that are going to benefit from your estate. I have one slide, and it's so that you can take a screenshot or take a photograph of it so that you have some of the key documents that I think everybody needs as part of their estate plan. So really quickly, I could talk for a couple of hours about all of these things, but just at a high level, there are 2 documents that are part of an estate plan, but really are for you during your life and take care of you while you're alive. One of them is a financial power of attorney. This is the document that's going to help somebody be able to act on your behalf with respect to financial assets. That's something that can go into effect when you're incapacitated, or can just be in effect as soon as you sign it, which actually can be a handy thing. A lot of spouses will name each other as agent under a power of attorney, and then that way, if you don't want to go to the refi meeting, you can send your spouse to the refi meeting with your power of attorney and say, thanks so much, honey, for taking care of that. So that's the power of attorney. There's a healthcare power of attorney, which is something that only goes into effect when you're unable to make healthcare decisions for yourself. So there are some technicalities there, but that's a good thing to have in place in case somebody needs to make healthcare choices for you. Part of that, or as a separate document, will be a living will, which is a directive from you about what sort of end-of-life treatment you'd like to have either withdrawn or withheld if that need should arise. Again, those take care of you during your life and are some of the shortest documents. They can be some of the trickiest to execute because you have to make some tough choices sometimes in those, but I think if you have a good attorney, they will explain it well to you and help you sleep at night, because they're just tuck them in a binder and that's done. There are two other documents. There is a last will and testament, and I would argue that a lot more people need trust agreements than have them. So your will is the document that will control the assets that have to go through the probate process at the probate court level. We work a lot with our clients to try to avoid probate, but you should still have a will in place for things that just don't get caught in terms of having beneficiaries designated or getting titled in a trust, which I'll talk about in a second. The will is also where someone names guardians for children. So that can sometimes be what prevents people calling their attorney because they don't know who that person should be. And I would just encourage you to get those conversations started with respect to your estate planning, because that's a hard thing to choose, that role, but you will get there, and it's better to kind of keep the ball rolling and not just prevent it. And then if something, God forbid, should happen, nobody is named and family is left wondering what should happen, and you might have a lot of family who might be arguing over who is the right person. But so if your wishes are out there, all of these documents are expressing your wishes for what you want to have happen. That's why they're so important, which again, it looks like it's about money, but it's really about what are your goals and what is your vision for you and your family, whatever that family looks like. A trust agreement is something that establishes a trust, which is a vehicle that allows you to avoid probate when things are titled correctly. It allows you to provide for family or causes that are important to you, and allows you to provide for them in a certain way, sometimes over time. Very often people who have minor children, a trust is a great idea, even if you don't have, again, a high net worth. That doesn't matter. This is about making sure that the vision you have for your people, whoever they may be, is to your liking. There's also beneficiary designations. Beneficiary designations are going to be a big part of the 401k, the IRA, those CDs, life insurance, those sorts of things. Those are also tools that can allow you to avoid probate. And you can use the trust with those too. A trust can be a beneficiary on those types of assets. The other thing about a trust, before I forget, is also that provides you some asset protection, or your family some asset protection. I could talk about trust for a very long time, but suffice to say that I think it's an excellent tool, and I think more people probably need them than realize. The other thing that I would piggyback on with what Andrea was saying in terms of automation would be for your investments, but also charitable giving, which I see as sort of part of, again, this estate planning, which can include things that you're doing in your life. There are ways to, again, automate payments to charitable organizations that are important to you. And I think that it's overwhelming sometimes to think about, where do I want my money to go? And you'd like to write a big check. And I think if you're doing it over time, every month, in a way that just you kind of set it and forget it, you will wake up one morning and realize, oh, for the last 12 months, I've given $100 a month, and you've given $1,200 to charity. And again, coming to the decision of writing a $1,200 check is just different than saying, look, here's my budget, here's my 401k, here's my kid's 529, and now here I've got this little extra that I'm going to use that my financial advisors have said I can spend, so I'm going to send it here. Doing that during your life kind of gives you builds some muscles for charitable giving, which you might then put into your estate plan later on. I think you can also think about if there are beneficiaries and people that you want to do gifting to, and you'd like to make larger gifts, but you want to do it over time. You can also do that as well. These are just ways to, again, automate it, set it and forget it, and you can also set those to increase as well, just like Andrea was saying. So again, I think estate planning encompasses more than just like what happens to my stuff when I die. I think it starts with the goal and the vision that Laura talked about. I think you can implement it with that automation that Andrea talked about. And I think it's very important, as Andrea said, to have the right people in place. You want an attorney who does practice estate planning, and an accountant and advisor can help make that estate plan something that you can just sleep at night knowing that when you're gone, it's all taken care of, or if something happened to you, the people would have what they needed to make sure that you were cared for. I think that wraps up our presentation today. So thank you very much for joining us, and take care.